Last year was probably the most difficult year for healthcare investing. It's unprecedented how much policy volatility there is.
Investors are going global, and so are we this episode. We speak with the head of global equities at BMO Global Asset Management. Jeff Elliott has decades of experience and a rare combo of an MBA and a PhD to find opportunities around the world and specifically healthcare amidst a battering ram of policy changes.
You have to decipher what's real and what is not actually going to get implemented.
So are you willing to kind of put your money where your mouth is on UnitedHealth or managed care in general? Tell me, look into my eyes and tell me, do you like Pfizer?
I'm looking away now.
When you choose a Raymond James advisor, you're getting more than independent financial management. You're getting access to complete financial guidance under one roof. From tax and estate planning to trust services for generational wealth and strategies for life's key milestones like buying a home, funding your children's education, or preparing for retirement, they bring it together in one financial plan. What also makes Raymond James advisors unique is their complete independence. With no proprietary product to promote, you will benefit from personalized services, all backed by the strength and resources of Raymond James, a powerhouse with $100 billion in assets and over 520 advisors nationwide. Discover how Raymond James can help you live a life well planned. Visit raymondjames.ca. The information provided in this podcast is for informational purposes only and does not constitute financial, investment, or professional advice. The views expressed by the host and guests are their own and do not necessarily reflect the opinions of any organization or company. The host and the guest may maintain positions in any securities discussed on the podcast. As always, consult with a qualified financial advisor or professional before making any investment decisions. In this episode, we discuss UnitedHealth, Pfizer, and Eli Lilly, which are all stocks that I own. Hey everyone, welcome to a brand new episode of In the Money with Amber Kanwar. On this episode, we're talking about the phenomenon of U.S. stocks underperforming the global markets. That was the trend in 2025. And as we kick off 2026, it's sort of the trend again. The Canadian markets, the Japanese markets, the Hong Kong markets are all outperforming the US. Europe is struggling a little bit, but still holding on to some of the big gains that we saw last year. In this episode, we're talking to Jeff Elliott. He's with BMO Global Asset Management. Now, his mandate is global equities. So we talk a lot about, where to be positioned around the world. But at the end of the day, a man after my own heart, he's a stock picker, and he started in the industry as a healthcare analyst. So that's still kind of his subspecialty. We talked a lot about healthcare ideas as expressed through this kind of global worldview. And healthcare as a sector is super interesting right now. I know it might not come with all the same pizzazz as like the Mag 7 or gold and energy. And I find our healthcare episodes actually, you're not as interested in them. But I think Jeff makes an argument for healthcare that's worth listening to. You're at a time where there's a lot of policy changes that maybe the bark was worse than its bite. The healthcare sector on the S&P 500 as of right now in 2026 is the second worst performing sector. But within that, you've got Moderna that's up 52% and Humana that's down 24%. There's a lot that a stock picker can do just within healthcare alone. We talk a lot about we talk a lot about different names and ideas, names that he says don't touch, and names that he thinks are kind of undervalued or undercovered. So, as always, let's get into it. Jeff Elliott, thank you so much for joining me on the podcast.
Thanks for having me.
You are head of global equities, and I'm sure you know this. Everybody wants a piece of global equities now. We're done. It seems like we're done with the US. What do you say to that statement?
I don't think we're done with the US. It's still the, biggest and fastest growing economy in the world. There are a lot of very good companies there. And even if you're investing in the US, you can get a lot of global exposure. Now, it is a broader market probably than it was over the last couple of years, but there's still a lot of great ideas there.
Help me understand how your exposure to the U.S. has evolved, especially after last year where we saw a rare year where the U.S. underperformed global markets, including Canada.
They did. And so we were quite exposed to the US. And, as you've had Malcolm on the podcast as well, and you've seen the sort of global AI CapEx boom, and that's very much a US story, and we've made a lot of money there as well. But we did start to broaden out a bit last year. So Europe became attractive in a lot of sectors. There's places you can go outside of that. Even the emerging markets are looking a little bit more attractive. So it is a diversification. We are still pretty well exposed to the US, though, because some of those big companies are there. We're still relatively positive on the US consumer. So there's a lot still to do. But you have to look broader than that because, as you said, the US did underperform. Canada had a good year last year, which has been a while since Canada had a good year. So it is sort of important to keep your finger on everything with that. The way we do, though, our investing is we're not really looking regionally particularly. We buy companies and we buy stocks. So it's stock pickers at the core, and then the geographic just sort of falls out of the stocks we like rather than dictating we want to be in Japan or we want to be in China. That's one of our inputs, but it's not the driver for us on why we put stocks in our portfolios.
So, the ethos out there right now is the so-called sell America trade, and that, political uncertainty, this is one of the things, political uncertainty has this insidious effect of making countries want to diversify. And now, oh, by the way, we're starting to get a return for diversifying. You can come back home to Japan, get a little bit of yield. Our stock market is doing well in Europe. Now you're finally getting fiscal impulses. How do you think about the interplay of those two things?
Again, we kind of always take it back to the company level and what we're seeing from a fundamental, because, you talk to Mal, you're talking to me, you'll hear some of the sector specialists. It's very bottom up from the company. So it's more how that impacts a business than how it impacts how we construct the portfolio necessarily. So it is, we have increased our exposure to emerging markets with a couple of names. We've broadened out in Europe as it was attractive. Canada, not so much in the global portfolios, despite them doing well. It's a relatively narrow market in Canada, obviously. So again, it's more how that translates to the companies than whether or not we have enough exposure to Japan writ large. Because I don't actually think we're great on our team at picking regions. We are very good at picking stocks. So it's more about taking the inputs from macro to make sure that we actually buy the right companies. The geopolitical stuff is interesting. That's all I will say. That I cover healthcare, as you know. It has been very interesting, some of the interplay between politics and policy and how the Europeans are going to deal with some of the things that the US administration is trying to do. So it's dynamic. But, from our point of view, we're active stock pickers. We like volatility at some level. We like mispriced assets. And all of these sort of turbulent times caused mispriced assets.
Well, you've come to the right show because I love asking questions about specific stocks, but I'm still going to force macro on us just for a little while longer. And you keep referencing this interview we did with Malcolm White, your pal and coworker.
Oh, I don't like him much, unfortunately.
at BMO, who is so whip smart. And we did that episode in December. So go through our episodes and find it. Pause this one, maybe.
No, don't pause this one.
And listen to it because it was really insightful on tech, and we're going to get your views on healthcare. But sticking with the macro for a second, let's take Europe as an example. You're finding good companies there. I assume they're more attractive now than they were a couple of years ago, or maybe not. But Europe has this habit of being a little bit of a value trap. Every time we get a rally, it's a head fake.
Yep.
So again, don't tell me it's all about companies, but it
is all about it.
But is this time different? Are the conditions present for the companies to do well in a way that they weren't a couple of years ago?
I think it's going to be an interesting dynamic. And you sort of have to separate it by sector and things like that, because obviously a European healthcare company is very different than what a European bank would be experiencing. And so, the economies in Europe are not fantastic. There will be a little more self-reliance. I think we are, with this sort of deglobalization that is being sort of imposed upon the world. You're going to see new alliances form, and there will be opportunities that come from that, where people become a little less dependent on the US potentially and have to see those shifting, tides in terms of that. So, the valuation matters, but, you reference value traps. I've seen this, I've been doing this long enough. I've seen people say it's got to be cheap enough now. I think we're going to talk about Pfizer at some point. We can have a discussion about value and valuation with that.
Wait.
But it is certainly that is part of the picture. the relative values within the regions, but it sort of comes back to what the economies are doing. And the US deglobalizing, some of this pullback is not going to be incrementally beneficial for anybody. So it's really who can insulate themselves from that better, who can be a bit self-reliant, and how do you develop in this new world order a little bit.
So it sounds like you're not getting too carried away with the idea that global equities, it's a new regime shift, and you're all in. I think that's important for investors to hear, because they've done just fine being 60, 70% overweight US.
Yep.
And they might be hearing and reading, oh gosh, now I have to brush up on Europe and Japan and all these regions. What's your key takeaway?
I think if you look at what happened with the market last year, it didn't actually re-rate on a multiple expansion on the US. It was earnings growth, right? Earnings growth drove the market. We exited 2025 basically at the same market multiple as we entered. So it was driven by fundamentals. And I think if you follow the fundamentals, you don't need to move from one region to another. The reason the US, historically has done well is because there's been a lot of earnings growth within that, both, because the consumer's been strong, but also because the companies have been very strong. So for us, it's really about following the fundamentals rather than worrying about regions. We do use it as a diversifier, though. And that's the thing is, if you are too exposed to the US, if there is policy shift there, and again, we all know there's a lot going on the policy front in the US, you have to be a little careful about that you don't want to overexpose yourself, because it's about portfolio construction when you look at that. So, you said, don't tell me it's about the companies. It's always about the companies for us. So I will
suppressed you here on this podcast.
I will come back to that. But, the one thing that you have to look at, and this is sort of where the regional part comes in, is, we make our picks, we like our stocks, we have our sector experts who decide where they want to be. But then we have to look at how the portfolio comes together. So if we were, everybody came back with their best ideas and we looked at the portfolio and it was 100% US, then we would start to look at that. So it's more a secondary thing. So the regions drive the fundamentals of the companies are what we pick. And then the portfolio construction has to be balanced so that we don't end up 100% in the US or, 100% in Japan or something like that.
Every weekend in 2026 comes with a new policy surprise. What does that mean for you as an investor? If you're doing this bottoms up approach, then you're looking at countries. Where are things like tariffs and?
Yeah, it means I don't sleep much is really what it means. It is, and again, I think it's unprecedented. Certainly in my investing career, it's unprecedented how much policy volatility there is, and then how you have to decipher what's real and what is not actually going to get implemented. And it's a bit of a guessing game around that. So it really has to be, what do we know in terms of what is real? What do we think is, bombastic declarations? And how do we take, a combination of a shorter term and a longer term view? Because, you can try and trade every little policy deviation, and there's probably money to be made there. But, that takes a particular set of skills to be able to trade that quickly. And that's probably the hedge fund world where they try and do that. We're not that. We're more long only, disciplined investors. But we also don't want to ignore it entirely. So if you look at in 2025, we de-risked the portfolio after, I'm talking about sort of the key mandates. We de-risked the portfolios after Trump was inaugurated because we could see a lot of volatility and the markets were priced for things to be quite stable.
What does de-risk mean? Like, so we raise cash?
Yeah, well, no, we don't raise cash in the global equities portfolios because my view is cash is not an equity. So, the innovators portfolio, we have some portfolios where we will hold cash defensively, but it's moving sort of into more defensive stocks or things that are less policy volatile. And so we'll bring the sort of risk of the portfolio down. And then through Liberation Day, we saw what happened with that. And then we re-risked the portfolio. So we want to be a little bit tactical, but not trading every headline, because we saw what happened in the last few weeks, right? We're going to take Greenland if we want it. No, we never use force. We're fine. We got a deal. That was an arc of 3 days, right? And so if you try and trade that, you're probably going to miss.
Now, and that is why everybody talks about the taco trade. Trump always chickens out. But unfortunately, for you as a healthcare specialist, it seems like there's no chickening out there.
No.
Oh, fine. You told me, but it has been hammered. by policy.
It has. And the way we look at healthcare, so I've been doing healthcare for a long time. Healthcare is great because there's a demographic tailwind. It's relatively economically insensitive. But ultimately, it's a single payer system and you're a price taker in healthcare. And even in the US, where everybody's like, oh, but it's private market. It's not like Canada where it's single payer. It's still government dependent, both because Medicare is a big spender and that is government policy, but also even on the employer side. The reason why there's, gold-plated healthcare plans in the US is because it's a pre-tax deduction. So that it is still government related. And I lived in the States. I had healthcare there. I had healthcare here. If you have healthcare in the States and you're employed, it's great. If you don't, you have nothing. But so it is always dependent on policy. And last year was probably the most difficult year for healthcare investing from a policy that I have seen in my career.
And yet, how did your funds do? We
did well, actually. I mean, didn't do better than the overall market, but our global healthcare fund was up 14%. So we outperformed. It's a pretty good result.
How did you do that? You weren't in cash?
We were not in cash with that. No, we moved around the subsectors a little bit. So we were underweight pharma during a lot of that turbulence around the most favored nation pricing and things like that. We were in med tech. So it is trying to, tiptoe through the raindrops a little bit in terms of the policy. So what I would say is he did chicken out in terms of what he was doing with drug pricing, right? The headlines of what he said he wanted to do on most favored nations were very big. And it was going to be, 50% tariffs if you were bringing things in. We were going to reduce all prices to the average of, the G7 nations and bring prices down. And then he started doing deals, right? And that was Pfizer was the first one to do the deal. And then Lilly was the next one. And those deals were actually not that bad for pharma. We upgraded healthcare in the sort of larger portfolios to an overweight in August or September of last year, figuring that he was going to come to the table and get deals, because it was never really about making massive changes to the healthcare system. It was really about telling people he had made massive changes to the healthcare system. So he got his victory moment in he got the deal with Pfizer, he got the announcement with Lilly, and now he can go back and say, look, we reduced drug prices for you. But did he?
Well, let's find out. We've got a lot of questions in the mailbag about health. So let's do what both you and I love and just talk. Yeah, let's talk stocks. Okay. Well, this actually first one has been another sort of victim of maybe drive-by policy in the U.S. It's UnitedHealth. Long-suffering shareholder over here.
That's how long? It was good for a long time.
Yes. Sorry. No, I only caught it after it.
Oh, okay.
Bad times.
Yeah.
It maybe felt like a long time, but it hasn't been. Because I'm a sucker for these big stocks.
Sure.
Are at 52-week lows.
Yeah.
Things have been rough for UnitedHealth. This is coming from Mark. Would you consider the latest drop an opportunity to buy? And the latest shoe to drop is, and you have to understand how the U.S. system works, but their Medicare Advantage program, which is funded by the government, was supposed to receive a 5% increase in payment. And instead, it received basically 0% increase. And all these companies dropped. Now, what do we do?
So here's the thing. This is, I think, very similar to what we saw with most favored nation. So, if you talk to policy experts even going into that decision, and I was on a call with one on Monday, and they all thought it was going to be a 5% increase because it's supposed to be based on utilization. So how much has cost trend gone up for these companies? And that's where you're going to set the rate because it's supposed to be fair. And so that was 5. And then what we got this week was what's called the advance notice. So that's the first rate. And then they can sort of have discussions. And in April, they'll get what's called the final notice. And that usually improves by, call it 100 basis points. So in this case, it would go from 0 to +1, which is still not the +5 that everybody's hoping for.
Yes.
My suspicion, because even if you had people who were talking to people consistently within CMS, and CMS is the one who essentially administers the Medicare program, they didn't think it was going to be 0. So this came from a very high up place. This was not normal staffer things.
Yeah.
So what I think is quite possible is this is an attempt for the administration to get the managed care companies to come to the table, to give them something. Because I'll say this. The user of the Medicare Advantage program, again, if you're not familiar with it, I know you are, but it is for old people, essentially, in the U.S. Over 65, you get government sponsored, and that's Medicare. Well, older people tend to vote. And if this gets left as is, what the only reaction that the managed care companies can take is to cut benefits. And if you cut benefits and all those policies come out in October, that's right before the midterm election. So I think it's very unlikely that this will stay as it is until the midterm election. Because I think the last thing that the current administration wants is a bunch of disenfranchised seniors going and voting against them because their benefits have been cut. So I think there's room for those rates to come up fairly significantly in April. I think the managed care companies will be incentivized to try and reach some sort of agreement with the administration, and what that is.
It's like Greenland negotiation.
Exactly.
It's like, I want all of Greenland when secretly you only want
Because look,
things.
I mean, the administration and Trump himself is a negotiator, or that's how he views himself. And that's ultimately what Pharma did. And Pharma's deal was actually pretty good. So if you look at Lilly, and it's a stock we've held for a very long time, they had to give up some price on some old drugs, and then they got expansion of coverage of the GLP-1s. I think Lilly actually comes out a net beneficiary of that deal, but it still allows the administration to say, look at the deal we made on drug prices.
So are you willing to kind of put your money where your mouth is on UnitedHealth or managed care in general? Like, what would you pick up on the back of that if this is your conviction?
Yeah, I mean, I think that it will be volatile for the next little while. So whether or not now is the exact time, I think is still a little bit debatable, because you're going to have to see how that plays out. UnitedHealth is the kind of stock, and we own it in some of our mandates, and so we've felt it a bit this week. We don't own it in all of it, and in some of our more active mandates, we actually owned Cigna instead of UnitedHealth because they don't have Medicare Advantage exposure. So we were trying to not be here for this for all of it.
Yeah.
But we do own it. It's the kind of stock that in the long term, I think is great, right? It's an important part of the healthcare system. They have a lot of touch points, but there's going to be some policy volatility. And I think the reason that UNH went down as much as it did is because it became a very popular long for generalists to go in. They had given guidance for 2026. People thought it was a very safe stock to be in, and lots of good reasons. And I've owned UNH probably longer than you have.
You have, yeah.
We bought it at $110 originally, so we've seen a bit of a round trip on this. It's one of those ones that you either have to stick with it and feel like they play an important role, they will get through this policy stuff, or you just have to wait it out a little bit. So it really depends on how much risk you want to take in the interim, how cute you want to be with timing. So long term, it's fine.
I'm in it for the long term.
Well, then I think
you won't tell your age, but I'm 39. So.
Yeah, me too.
Before this Medicare Advantage, there were lots of other problems with UnitedHealth, and just generally, yes, they're dominant, but they're slowing.
Yeah,
and there are questions about their business practices that were really, tragically brought to the fore with the assassination of one of their division CEOs. And the stock just really hasn't recovered since then.
I think if you look at UNH, and we've been involved and not involved, like it's a stock I've known for a very long time. I've been down to Edina, Minnesota a couple times to visit them. It's, I think it's an important part of I don't think it'll be completely disintermediated. I think, they had some operational issues. UNH is tough to get a real handle on because there's a lot of moving parts within it. And I think they were holding things together, but behind the scenes, things were not as good as it seemed like. And some of that sort of came out over the last year. And the business policy stuff, some of the attention that they've got from the regulators has been unfavorable, and it always will be. I mean, healthcare is a very emotional part of people's lives. If your house insurance is, being a bit bad with you, that's one thing. But if it's health, it's very emotional and very important to that. And so, I think there are some things that every insurance company doesn't do exactly as you'd want them to do. And it is a natural thing for people to criticize.
It's always been a group, too, that does well in a market where people want to be defensive. Yep. And is that still a characteristic of healthcare, given all this policy volatility?
I think if you think you're on the back end of the policy turbulence, then yes. And that's part of the reason we upgraded the sector, is we felt like we were coming to the end in the pharma. In managed care, we're clearly not through that yet. And that is what I think has happened, is I think people were hoping that they were, and then they found out they weren't. And there was a lot of faith in the whole notion of they won't mess with managed care in an election year because of the midterm. So I think that was a lot of the surprise as well, is Why are they going after this policy thing? And again, I think it's so that they can declare victory at some point on these.
Okay, well, I promise we're not going to talk my book the whole time, but as
long as you got healthcare stocks, I'm happy to do it.
Do you want to bring up Pfizer? Again, sucker, low valuation, what seemed like a good enough pipeline. Activist comes in, 6.66% dividend yield, actually 666, which maybe is ominous for Pfizer. At least on the day that we're recording, the dividend yield is 6.66. Do you like Pfizer? Tell me. Look into my eyes and tell me, do you like Pfizer?
I'm looking away now. I haven't liked Pfizer for quite some time.
Tell me why.
I don't think they have a very good pipeline in general. So it has a great dividend yield. And we own it in one of our dividend mandates, largely for the dividend yield. It has a quite cheap valuation where, it's whatever, 8 point something right now on PE. So there are some things that lead me to believe Pfizer doesn't have a ton of downside. The pipeline just has not been great historically. And Pfizer's just not been historically a great research and development company. They're a really good sales organization. And so what Pfizer did well, sort of 90s, 2000s, was buy companies and then sell those products. But, when I talked about healthcare and why it's good and the fact that it's bad because it's single payer, our view on healthcare, if you want to consistently make money in healthcare, is you have to do one of two things. You either have to save people's lives or meaningfully improve the quality of life, because then people will pay for it. So an example is AstraZeneca has a lung cancer drug called Tagrisso, which meaningfully extends people's lives. Governments will find a way to pay for that because it's a change. Or you have to save the system money. Pfizer gets stuck kind of in the middle, and they sort of had that old model of we'll get a drug and we'll sell it to a lot of people. That's a tough space to be right now because there isn't enough money, and drug pricing is a focal point for everybody. It is now. It used to be a Democratic sort of rallying cry. It's now bipartisan. And so you can't just take price. You can't take your 9.9% price increase every year. And so I think Pfizer just has not done a great job of doing that. So they got the COVID windfall, which they didn't invent, right? That was BioNTech. It wasn't them. And then they bought stuff with it. They bought Seattle Genetics. So can you buy things well enough to make money off them? It's hard to do in pharma.
So they're never going to come out with the pill, an oral GLP-1. Well, they've been trying in fits and starts.
Not very many people have been successful in that space. Really, it's just Novo and Lilly. Yeah. Maybe Roche has got something now. And then Pfizer obviously bought MedSera. And that's sort of what the Pfizer pipeline depends on right now, is the once weekly and once monthly GLP-1s. So,
and obviously you're not optimistic.
Look, I think they will probably work. Do they work well enough to displace the incumbents? And is once monthly dosing enough to really differentiate? I don't know.
When an activist investor came in, Starboard Jeff Smith, was it like, were all these issues apparent? Like, did you have a dose of skepticism? And like, what are you going to do? Yes.
And I think part of the issue with a company like Pfizer is it's big. It's hard to turn it, right? Starboard also doesn't have a great history in healthcare, if you want to look back. So I've actually made the mistake of being very excited once with a company when Starboard got involved and it did not end up well. Okay. So I have a little less faith in Starboard as value creating in healthcare necessarily. But the question with these companies is, what can you do? What can you force them to do? Like, what do you say? Do better research? I mean, I think they all try. Yeah. It's hard. And it's very rare that a pharma company can turn their pipeline effectively. They all say they will. And I remember I had a really interesting conversation with the CEO of GSK. And she asked, do you own our stock? And I said, I do not. She said, why? I said, well, because your pipeline's not great. She said, but we're doing all this great stuff to fix our pipeline. And I said, I've heard that from every pharma company I've ever talked to, and it very rarely works because it's hard to turn a big organization and get them to find new stuff. So the only ones I've really seen successfully turn their pipeline around, AstraZeneca under Pascal Soriot did a great job. They went from sort of a very bad R&D company to a very good R&D company. And Lilly's obviously done a good job. And it has been the shining star of U.S. pharma, certainly, for the last 5 years.
Let's contrast Pfizer with Moderna.
Yep.
Obviously, another stock that is like roadkill post-pandemic, except...
For the last 6 months, or 4 months, really.
4 months. It is making some promising developments and releases around cancer vaccine.
Yep.
Personalized cancer vaccine.
Yep.
Which sounds so futuristic, but maybe is not super futuristic after all.
Yeah. So Moderna is interesting. So they were another one that had a massive COVID windfall. They do not make money. They lose money. Their intent is to be cash flow positive in 2028. With the amount of money they made on those COVID vaccines, they probably could have been profitable. They spend a lot of money. So why has the stock worked in the last 4 months? And the answer is nobody really knows. There was a very big short interest in it. I think there's been a lot of covering on the short interest because of some of the
20%.
litigation. Yeah, but it's lower than it was.
Yeah.
So there's a litigation ongoing between them and Roivant about some royalties. I think people are worried about being there in case Moderna wins that case. They talked to JP Morgan and said, we're going to spend a little less going forward. And, again, you'd like them to actually make money at some point. So they're going to deprioritize their infectious disease and respiratory vaccines because of the, what's going on with HHS in the US and the view of vaccines broadly in the States. And so they are focusing on the cancer vaccines. And they've had some pretty interesting data in melanoma with their cancer vaccines in combinations with the immuno-oncology agents. I've been, doing healthcare investing for a long time.
I tried to ask how long.
I'll tell you this. I got my PhD in 2000. So that's you can back calculate it. So unless I was Doogie Howser, the math's pretty straightforward on this. So, and my Doogie Howser reference also makes me seem very old. So I realize that. But cancer vaccines have been on the table for a long time. This is not the first cancer vaccine company. You can find some cancer vaccine failures in Canada as well. It's hard to do. So, it's promising. It's what you want to believe will work, especially personalized cancer vaccines. But cancer is sneaky. And it's the reason why cancer is still here. The reason why we can't cure it is not the same. It's not one disease. It's 1,000 diseases. It changes over the course of time. It defends itself. And so it's very hard to do this in a systematic way. So if you think about the immuno-oncology drugs, so this was a big success story. So this is Merck's Keytruda and Bristol Myers Opdivo. This was using your immune system to fight cancer, right? I know people who've been cured by this. It really was a big advance. But it doesn't work in all cancers, and people wanted it to, but it only works in cancers that are immunogenically active. So basically what happens is you have cancer, and then cancer sends out a signal that says, don't look at us, we're fine, and keeps the immune system away. We all get cancer like 3 or 4 times a year. It's just your immune system recognizes it and shuts it down. And so what happens with some of these cancers is your immune system just decides it doesn't see it anymore because the cancer cells themselves are putting things out. And so you have to have this combination of being immunologically active and turning the immune system back on. So that's what the immuno-oncology drugs did, but they basically took the brakes off the immune system. But it only worked in a subset of tumors because not every tumor is immunologically active. So something like melanoma is, something like pancreatic or gastric cancer is not, which is why those agents haven't had a lot of success. So what they're trying to do is take cancers and force the immune system to recognize them. And that's the personalized version.
Yeah.
If I take your cancer cell and I figure out exactly what the outside of it looks like, and I can make that into something that'll stimulate a vaccine, then I'll give you the vaccine and you couple it with the immune system, it'll work sometimes. Is it going to be sort of a pan-cancer therapeutic? I think the answer is no. So they'll find niches within here, I think, that are probably successful. But the notion of like a big overarching cancer vaccine is not high. And a personalized cancer vaccine is great if it works, but it's not scalable particularly either, because you'd really like to have something that's off the shelf rather than I need your tumor, I need to, get the antigens and do that. So there's stuff that's interesting scientifically there. Business-wise, I don't know.
There's almost nothing to this rally.
I think there is. It is hard to imagine that they will sustain themselves. Now, they could get lucky. Something could work very well. And that's, again, if you're investing in biotech companies, there's an element of luck to all of this. I think we were talking earlier, I was a sell-side analyst. I did small-cap biotech. And the line I used to use with clients, and this is marginally insensitive, but I think it'll be fine, is investing in a small cap biotech is like playing Russian roulette, and doing due diligence takes some of the bullets out of the gun. You can never get them all out because you can do everything right and still be wrong. And so it's possible that it works. It's possible that they find the sort of killer app, but I'm not sure that the risk reward is appropriate. It certainly wouldn't be for us.
Is there anything interesting there for another player? Like, does Moderna get bought?
I don't know. I mean, it's their base business is going to, like, I think, and I haven't spent tons of time on the Moderna guidance.
Yeah.
But I think if you look at what Pfizer assumes for COVID vaccines is much more reasonable than what Moderna assumes for COVID vaccines. Because, vaccine rates tend to go down over time. Certainly there's been a bit of a backlash against vaccines, and certainly preventative and the COVID vaccines in particular. Because if you look at compliance rates for COVID vaccines in the middle of the pandemic, it was obviously very high, somewhat mandated. Flu vaccines, which are, far less controversial, they're still only 50 to 60% uptake, even in vulnerable populations. So I think it's hard to imagine that the COVID vaccine market is going to reaccelerate at any point. If it does, we're all going back home at some point. I don't want that to happen. So,
yeah, neither do I. We can't go back to that. Okay, we actually got some questions that are not biotech.
Okay.
Which I feel like, I don't know, do I even want to ask you about Nvidia? You gave such great answers.
You can, but what's it called, Nvidia? I've not really heard of it, but
should we call Malcolm?
We probably could.
No, I because a lot's changed. I know it's only been a month since Malcolm has come on, but I think the idea of tech leadership has, I don't want to say it's stalled out, because then like the next day it's back.
Yeah.
But it's not as much of a straight line as it was. And there's big dispersions within the Mag 7.
Yep.
Alphabet's a big winner. Apple's a big laggard.
Yep.
Before I get into some of the tech specific questions, like high level, how are you approaching tech in the Global Equities Fund?
Well, we're still positive on the AI CapEx cycle. And I know Mal would have said that when he was here, but no less positive now. Obviously, it's a little more difficult. Again, I always joke when we bring junior people onto the team, I'm like, we have a very simple job. We just have to buy a stock and sell it to somebody for more, right? Simple is not easy. But the big part of that is how well is the story known, right? Someone has to buy the stock. It's not like any of these stocks are not well known at this point. So the notion of just broad momentum and people learning what Nvidia are is not there. So you have to be very sort of cautious on the momentum versus the fundamentals. And so, our team travels a lot. That's a big part of the due diligence that we do. And Jeremy Young, who works with Malcolm, he's another one of our tech PMs, spent 3 weeks in Asia in December doing semi-supply chain checks. He went to Taiwan. He went to Korea. He did sort of the whole thing. And he came back very positive about the demand cycle still and the sort of CapEx that's going in there. So we don't really think it's over. It's just harder now because more people are aware of it. And you have to be very systematic about where you place your bets. And Nvidia, I'll jump right into it.
Yeah, we got a question on it.
We still like it. And we are overweight in most of our portfolios. Obviously, the very conservative or dividend-oriented ones, it's not going to be part of that. Basically, on the new product cycle, and what Jeremy has heard in terms of from Nvidia themselves, from the hyperscalers who are still buying, there's a lot of CapEx going on.
We can all see that.
Yeah.
Why isn't the stock moving?
I think the stock isn't moving because there's an attempt to broaden out a little bit this year, to look at other places where it's a little less well known. So some of the places that we've made bets in the portfolio are more on the memory side of things. And I think Mal talked about that then. And you've seen, like Samsung, I think was up 6% today when I looked last. Like there's a lot of places where there's sort of that secondary trade from AI, where there's probably a little bit more upside potential because they're not as well known. It's playing through everywhere, right? Like if you look at copper names are being driven largely on AI, right? If we look at, we've made a lot of money in things like GE Vernova, and that's power generation for AI. There's a lot of places you can make that. So it's not just Nvidia necessarily.
Well, you mentioned Samsung. We got a question on that. And if you look at these memory stocks like Micron, like SanDisk, but basically AI is hoovering up the demand for certain types of memory chips. It's taking away capacity for other memory chips that are used in more everyday ways. And so there's a shortage.
Yep.
And this is, it's almost like the AI chips maybe a couple of years ago. Talk to me about how we should think about investing in this trend? Because a lot of these stocks have already gone parabolic.
Yeah, well, I think they're still going to. Like if you look at the actual prices of like DRAM and some of these memory, it's parabolic, right? And that hasn't fully played through to the stock. So we still, like Samsung's one of our biggest active positions in the
Doesn't
global equity
destroy
portfolio.
Demand at some point? Like in commodities, the cure for high prices, the high prices?
Yes, but I mean, if you think about where memory goes, and I think your point about, sort of, if you look back to the pandemic when the car manufacturers couldn't get chips. And so you could only, if you bought a new car, you got one key with your car because they couldn't actually make two keys. And so, the term was the golden screw, like it was the most important thing. And I think people underestimate how tight that supply can get and then what it can do for the stocks behind that. So like, yes, we've seen those moves, but it's I'll tell you one thing, the tech team told us that if you want to, like, you better replace your iPhone right now if you're going to do it, because the prices are going to go crazy because that, anything commercial facing or consumer facing is not getting the supply because all of this is getting mopped up by the hyperscalers and all that. All the memory is getting dragged that way.
Do you think it has legs?
Yeah, we do.
It's not overvalued. I mean, how do you even value?
Well, and I think that's one of the most challenging things. And if you think about, again, not to go back to our model all the time, but how we do things is like the way that the tech team has to look at an opportunity is very different than how I would look at something in healthcare or our financials PM would look at something, because the financials PM is basically valuation, very sensitive. These guys in tech, like to do that successfully, you have to understand the product cycles and these demand cycles, because you can get in early, you can get out early. Like I remember when Mal, not even long into the Nvidia rally, like I will challenge people on the team, be like, is this too much? And he's like, nope. Because he could see the sort of where we are in that demand cycle. And I think for memory, they certainly feel like we're not.
So in the global fund, you've got, this healthcare, you've got tech. Before we get into your pro picks, I want to talk financials.
Yep.
And I'd love to know how you are building out your portfolio within financials. And I ask that because very strong 2025, particularly for U.S. financials, nice broad rally. And then 2026, what's happening? We've fallen out of bed.
Well, I think that is an area where if you look, and so John Hadwin's our financials PM, and he would tell you that a lot of the money centers, like the big US banks, are fully valued now. Like they're pricing in pretty strong economy, they pricing in appropriate rate structure, but there is still value there. And so if you were to look into some of our portfolios as well, and again, there's different mandates, so we run things differently. Yeah. But there's certainly in the Global Equity Fund, which is sort of our flagship fund, there's a skew to the US regional financials because they are not pricing in.
Small caps are cool now.
Yeah, well, there is a broadening out of the market, and again, if I think about some of our bigger bets in the financial space, it's things like Webster or Western Alliance banks, like things that a lot of people may not have heard of, but these are trading at high single-digit multiples with strong ROEs. Like there are still companies out there, even though it doesn't feel like it given what the market has done, there are still companies that haven't priced in a strong economy or even a non-recession economy. And that's where we're finding value in the financial space right now.
I remember Western Alliance because of Silicon Valley Bank. When it collapsed in 2023. Yep. It took down a bunch of these Western type of banks, Western US banks. And it has clawed its way back. Yep. It hasn't made new highs. It's not at the levels it was in 2021. What is a catalyst for like a Western Alliance bank?
Banks don't have catalysts the same way, other than bad catalysts like SVB had. Bank catalysts tend to be things we don't actually want to see.
The catalyst is no credit.
The catalyst is, no credit event, no surprise, non-performing loans. The rate structure going the way we expect it to, and really just running the business as well, and people moving to these. Some of these regional banks just take people moving out of the larger banks and looking for value. It's a place, financials is a place where valuation does matter a lot. And so if you have these lower multiple, high free cash flow businesses that have good ROE, investors will come to them because, if you price in a recession, at the lows, John was pounding the table saying, like, these are pricing in worse than 2008 scenarios. So this is the easiest money that you're ever going to make. And so those are some of the opportunities. And they have re-rated somewhat, but they haven't re-rated the way a JP Morgan or Goldman Sachs would have re-rated.
All right. Well, let's see if we can find some opportunities in your pro picks. So ProPicks is brought to you by ATB Financial. With over $100 billion in assets, ATB Financial is powering possibilities for more than 843,000 financial services clients. ATB Cormark Capital Markets is a leading North American investment firm providing holistic corporate and capital markets advice and full-service financial solutions. Visit atb.com/inthemoney for more information. Okay, your pro picks, not surprising because you're a healthcare guy. You brought us all healthcare names in different segments of the healthcare market. So let's start with Boston Scientific, MedTech.
Yep. So MedTech has been a little challenged lately as we've seen a rotation sort of back into the biotherapeutic space. MedTech was kind of the only game in town for a while within healthcare because it was sort of immunized from the policy stuff. And so we've owned Boston for a long time. We've owned it since we started at BMO. Like we bought it basically day one. So we've done well with it. We've traded in and out of it a little bit. We have added back to it. It's our single biggest active weight in most of the portfolios because it has pulled back. So it got up to about 106, 108, and then it pulled down back to just sub 90. And that was on a couple of things. Part was the rotation out of MedTech, but part was also that they did this acquisition of Penumbra, which is another MedTech company, a high growth MedTech company. And people were very concerned when they did that deal that they did it because their base business was slowing. And, that is often why companies do deals. That's not what the company says why they did that deal, but it's not why they would say it. So we'll see when they report in the next little while. But ultimately, it's trading at a valuation that we think is pretty attractive for a high growth med tech company. So the story on Boston for the last few years has been their device for atrial fibrillation. So atrial fibrillation, how nerdy do you want me to go science-wise?
My parents we have cardiac.
Oh, all my uncles have atrial fibrillation. So this is coming for me someday when I'm trying to avoid hitting the mic. So you have 4 chambers in your heart. The top 2 are the atria, the bottom 2 are the ventricles. So the atria pump blood to the ventricles pump blood to the rest of the body. Fibrillation is when it stops beating rhythmically. It essentially quivers. If that happens in your ventricles, you got about a minute until you're dead. And so you have to that's when you get the big paddles in there. Yeah. The atria doesn't kill you. It just isn't good for you. And you can use leads to put it back into it, but ultimately it'll fall back into atrial fibrillation. And it's not good because if the heart's not pumping continuously, the blood sort of pools down and then it has a tendency to clot. And if it clots, you can have a stroke. So ideally what you want to do is put somebody back into normal heart rhythm and keep them there, and then they don't have to do that. Because the treatment is you have to be on oral anticoagulants, so something like an Eliquis, so that you don't get that risk of, but then you have bleeding risk, so people don't want that. So what often happens in the cause of atrial fibrillation is there's just a locus of cells, so a little group of cells that has lost their ability to keep time, essentially. And the analogy I always use is like a synchronized swimming team. So if they've got 8 people and one person loses the ability to keep time, then they'll mess everybody else up. And so what you really want to do is fire the person who doesn't have time. So to fire that group of cells, you actually have to kill them. And so the way that you can treat this in a more permanent way is you take those cells and you kill them and then you put them back heart rhythm, and then they no longer mess up the rest of the heart. So there's 2 ways that you used to be able to do that, or you can still do it, but it was either you burn them, so it cauterize it essentially, or you freeze those cells to death. But it actually does a fair bit of damage to the surrounding heart tissue. So cardiologists didn't really want to do it. So Boston came up with something called pulse field ablation, which is a lower energy way of killing those cells without damaging the heart tissue. And so then they got a massive amount of adoption from cardiologists because it's a much safer way to do this. And so our view on that was it was going to be, call it a $3 to $5 billion opportunity on a $12 billion top line. And that's largely what has played out. There are other parts to the Boston Scientific story that are important now. So that pulse field ablation, that atrial fibrillation ablation technique is still there. It's still growing very nicely. There is some competition coming, and that's the other concern that people had around Boston. But there's something else called Watchman. And so Watchman is also for atrial fibrillation. So about 90% of clots that happen and strokes that happen because of atrial fibrillation, because basically blood pools in this thing called your left atrial appendage. It's just this little finger-shaped thing where the blood pools and if it's not flowing smoothly. So Boston has something called Watchman where they basically stick a device in there to block that. And so the blood doesn't go in there and it doesn't pool. So that has data coming out in the next little while, which we think will be positive. It's against oral anticoagulants. So if it's better than oral anticoagulants, I think we're going to see big adoption. So Watchman is sort of the next leg of growth for the base Boston Scientific business.
If the stock picking doesn't work out, you could be on Dr. Oz.
I know. I love talking about healthcare stuff.
I can tell the passion is coming out. Okay, so a few questions on that. What causes atrial fibrillation? Is it genetic or is it lifestyle?
Both.
And so now that we're all going to be super thin and on Ozempic,
Sure.
is that the catalyst for slower growth?
Let's say Mounjaro because we don't
Mounjaro,
really know.
sorry. Yeah, sorry.
I think ultimately it's not going to. There are lots of people who get atrial fibrillation, and that was the big fear in med tech stocks when it was really Novo's data that came out a couple of years ago, and all the med tech stocks plummeted because like nobody's going to be fat anymore. We're never going to have cardiovascular disease. That's probably not true. And we actually had some great opportunities to buy stocks at a discount on that. Because my favorite thing was when a sell side analyst came out and said, airlines will be more profitable because people will lose weight and it will cost less fuel. Now, one thing I know is airlines are never more profitable. They will always find a way to lose money. But that is sort of when you get to the silly season of a stock, and then you knew that it was sort of peak. So I think there will be advantages to this. We're obviously bullish on the GLP-1 class, but there's a lot of people who are going to need this for the next 20 years. You can't really reverse some of the damage that you do to your heart. And some of it happens anyway. It's not entirely being overweight or being high blood pressure. There is a genetic component to it.
Is the stock expensive? Is it too expensive for growth that's slowing?
We don't really think growth is slowing. And that's sort of the key thing. If you believe that, I think, and especially Penumbra actually, we think was a pretty good deal because it was one of the few assets that is in their core space that is actually growing faster. So it should be accretive to bottom line. So if you think about where Boston's trading, it's trading at, call it 25, 26 times next year's earnings, but it's still growing very strongly in sort of the teens. And so the PEG basis, it's fine. So we actually think that it's going to grow well still. And if we're wrong, then it'll be a problem. But that's our view on the opportunity for both Watchman and Penumbra, and still with the pulse field ablation with Farapulse.
I got one pullback right in my portfolio in healthcare, and it was Eli Lilly, which is one of your top ideas. I should have started with that, which is one of your top ideas. Explain to me why Lilly from here. And why Lilly has done better than Novo Nordisk, even though Ozempic is like the Kleenex.
It is.
GLP-1s.
Well, part of the reason why Ozempic is advertising as much in Canada as it is because they lose patent protection at the end of the year because a lawyer apparently forgot to file to get them a patent extension. So I assume that person is very fired. So that's part of the reason why you can't turn on a TV in Canada without seeing an Ozempic ad or a Wegovy ad, because they are trying to get as many people on brand before that changes.
Patent expires.
So, look, Lilly was easy money for a while. And like Nvidia, these are the sort of like overnight successes that actually take 20 years. The first company I ever wrote up when I was on the sell side was a company called Conjichem out of Montreal, which did GLP-1 attached to serum albumin. It did not work because everyone threw up, but we've known the potential.
I bet they lost weight.
They sure did. Yeah, you can lose weight. Oh, it did tend to come back on though once they stopped throwing up. And so GLP-1 molecule has been around for a long time and the potential's been there. It was only in sort of 2019, 2020 where we really saw the weight loss potential. And that was with semaglutide, which is the active molecule in Wegovy and Ozempic. So that's great. And Lilly had one that was very similar, right? Those are the two competing drugs. So why did they split and why do we still like Lilly? And the reason we like Lilly before they started to split, and we've owned them both over time, is Lilly has a better pipeline than Novo does. So if you look at the next generation, so if you look at orforglipron, which is their oral drug, versus oral Wegovy, orforglipron we think will be better, plus they can make more of it. Wegovy got to market, the oral Wegovy got to market before. CagriSema, which was supposed to be Novo's next generation to compete with tirzepatide, which is the active ingredient in Mounjaro and Zepbound, it just didn't work very well. And the data was disappointing, and that was data last year. And so Novo got as high as 1,000 and got, at the time of the CagriSema data, went down 15% from about 600, I think. And we had owned a little bit still in the healthcare fund, and we sold it at that point. And Lilly also pulled back after that too, which we can talk about. So really, it's just that we think Lilly has a better pipeline in terms of what's next. So they have orforglipron, which we think will be better than oral Wegovy. They have the triple G, which is retatrutide, which had very strong data, almost 30% weight loss in a trial that came out right before Christmas. And we'll see more data from that. I mean, there's a point where you can't lose more weight, right? Like you don't want 100% weight loss. That's not good.
Yes.
But for patients with the BMI of like 40, this is meaningful weight loss. And so we just like that pipeline. And Novo's just a little bit in trouble because their pipeline isn't as good. And Metsera, if it works, Roche, if it works, starts competing. So you have to keep advancing. So Lilly, I think, I know you asked the question, and I talk a long time sometimes.
No, keep going.
Lilly has better growth going forward than Novo does because of, I think, a better position in the oral market. I think better with the injectables as well. The market expansion that came with that deal that we talked about with Trump is going to be very meaningful for driving growth, even if prices come down. So there's just a better growth path for Lilly.
And when you talk about their pipeline, are you talking about their pipeline within diabetes and weight loss, or is it also the fact that they've got Alzheimer's? And
I don't put a lot of stock on the Alzheimer's. I hope it works. I hope for patients it works. Alzheimer's has been a very tough space. And even the drugs that have worked, like Leqembi from Biogen, haven't sold. And it's just it hasn't sold for a couple of reasons. It's hard to get infusion centers. You need imaging before you do it. It doesn't actually make you better. It just makes you get worse slower. And that's tough to do. And it's very restrictive in how you do it. So it worked. It just didn't work well enough. And a big problem with Alzheimer's, and this is the big challenge in the field, is by the time you know you have it, it's too late a lot of the time. So you have to keep going earlier and earlier. So the Lilly trial is in very early Alzheimer's, basically trying to stop it from happening. That's a tough thing to do. It's easier to cure something than it is prove that it didn't happen. So all those things are sort of upside, but I'm not too worried about it for Lilly.
Again, I go to valuation 40 times, more than 40 times. Yep. Is that expensive?
40 times this year, 29 times next year. For the growth that they have, no. Because if you look, by 2030, the top line should double, right? And you can pay a premium. Nvidia will show you that. You can pay a high multiple for things that are growing very well. If anything threatens that growth, or we see really good competitive data from somebody else, then that's something you have to question. But right now, there's a pretty clean path for very strong earnings growth at Lilly. And so it's not our number one holding, and we have trimmed it over time, and we've traded it pretty actively. We sold it down after the Novo data because we knew there was going to be sort of a competitive reaction from Novo. And in an oligopoly, the last thing you want to do is get in a price war. Yeah. And Novo started to do that a little bit. And then that was the sort of hims and hers deal. They've pulled back from that a lot because I think they realized that nobody wins in a price war.
Like a marketing platform that didn't go well.
It did not go well. And I think it got the CEO fired, frankly.
That's right,
So I think they are going to be a little bit more rational.
Your third pick, and I like this because it comes out of, it's not a household name.
No.
It's Belgian biotech.
Yep.
UCB.
Yep.
Looks like has pills for like Crohn's disease, Parkinson's, in that neighborhood.
The Parkinson's stuff, sort of the legacy. The big growth driver for UCB is a drug called Bimzelx, and so I
love these names, by the way.
Me too. Nobody likes these things. Like science guys, they love the jargon, right? Like I love.
I do, just as like a little hack, as somebody who doesn't have a PhD, I take all those analyst notes now, and I dump it in ChatGPT, and I say, write this in English. And I'm like,
I know, I don't like that because part of the rarity that we had is we could use all this jargon that no one could understand. So we became very important with ourselves. I remember looking up one time because one of the side effects of a drug was urticaria. I'm like, what is urticaria? I'm like, hives. It's a pretty fancy name for hives, right? But you don't say hives.
You get kind of itchy.
Yeah. So you say urticaria, and then people are like, oh, he knows stuff.
Okay, you can use all the big words, and then everybody just.
I will. I'm not as smart as people think I am, so I tend to use the simpler words. But so it's a drug for autoimmune diseases, right? And so it is essentially things for I won't give you the really crazy one because I'll probably mispronounce it as well. But it's things like psoriasis, right? That's the sort of original indication. So this is where your own immune system goes a little crazy and it starts attacking your cells and you want to just stop it. So the big drugs in these categories are things like Humira, which was the original one, or Skyrizi is a big one. If you ever watch US TV, you'll see an ad for Skyrizi. There's no question because nobody advertises more than AbbVie. Cosentyx. And so this is sort of the next generation of that. So they block something called interleukins, which are just inflammatory proteins. This just does a better job of that. And the reason why it's an interesting stock is a drug like a drug like Skyrizi is like a $6 billion a year drug in psoriasis. Cosentyx is a $4 billion a year. We think this will be $4 to $5 billion. So not necessarily bigger. It is, I think, better and it's taking share. But UCB is a much smaller company. So, a $6 billion drug for AbbVie just fills a patent hole that they had with Humira. Same with Cosentyx, right? Novartis. But this will actually double the size of UCB. So these are really exciting opportunities for us if we can find good science, a good molecule, particularly in a smaller company where it can really change the profile of that. So if you look at UCB, it trades actually not that different a multiple than Lilly, but the growth is fantastic and goes on for a long time. So the peg for something like UCB is 0.6, 0.7.
Price to earnings growth.
Yeah, you just don't see that very often, especially if there's not a real risk around the patents. There's not a real competitive risk. The biggest risk that they had was a company called Moonlake, which failed in their trial essentially last year, and that was a big gap up. And so UCB is just a very clean, very good story, very well run. I've seen them in Brussels a few times. The CFO is fantastic. She's really knowledgeable about her business. Like I walked away from that meeting going like, oh, she knows what she's doing.
Yeah.
So it is just a unique story. It's just, as you said, most people haven't heard of it.
Well, because why are we going to Belgium?
Yeah.
And
the fries mostly, but
the waffles.
Yeah.
Do you think that these kind of international stories, smaller stories, also benefit from like the fact that we're now hunting for them? We're looking for these opportunities.
For sure. And I mean, it's always interesting because, for a stock to really, and this goes back to we just have to sell it to somebody for more, there's a limit to the liquidity of some of these stocks. So there's a natural cap because you just can't, it's a family, they've got a dual share. Like it's one of those ones where you can't get the liquidity. They don't have an ADR, so you have to trade it on them. So not everybody can do it. But yeah, when you look for these durable growth stories, there just aren't that many, and people are willing to go outside. So there's another one called Organics, which we like, which is actually another Belgian one. I don't know what the deal is with all our Belgian stories, but these are just high growth, high quality companies that people do tend to look at as the next level down. And it takes a lot. I do some of this. Carmen Tang on my team does some of this as well. Like you need the science background to really dig into these things to get confidence around them. And so people tend to wait until it's obvious to get into them. And therein lies the opportunity for people with sector specialist
PhDs. You hear that, kids? Get off TikTok.
Yeah.
Get to school.
You don't have to do a PhD though. That's sometimes maybe it's too much, but it is a really interesting thing to sort of be able to go. And again, not to toot our own horn a little bit, but that's why we have the sector specialist model, right? It's something, if you're a generalist, you're never going to look at UCB. You need to have the time and the ability to go look for that, to find those opportunities that aren't that sort of standard story. And that's why the team is built the way it is. I think that's why we've had successes, because we have, you've talked to Malcolm, if you talk to John, like really deep expertise to go find these hidden gems a little bit sometimes.
Well, I've learned a lot. Thank you so much, Jeff, for joining me.
Thanks for having me.
That's Jeff Elliott joining us from BMO Global Asset Management. Make sure you stay tuned to our next episode. We're ditching the snow and we're going on the road. We're traveling to Phoenix. We're going to be interviewing Cole Smead and his father, Bill Smead. They run the asset management business together. We're going to get U.S. investor perspective on Canadian stocks because they love to traffic in some of these Canadian names, not just energy. I think they're going to unveil some new positions within Canada on the podcast. So make sure you tune in for that, and we'll catch you on the next episode.